5 Simple Rules to Investing for Beginners. Peter Lynch's advice. The Lynch Federation chairman, mutual fund manager, and philanthropist Peter Lynch is a prominent investor. From 1977 through 1990, he managed the Fidelity Magellan Fund, generating an AAR of over 29%, double the S&P 500 index of U.S. stocks. Magellan, the world's largest mutual fund, had $20 million in AUM when Lynch took over as manager in 1977. By 2000, it had $13 billion. Lynch has generously shared his financial strategies in One Up on Wall Street, Beating the Street, and Learn to Earn, which have inspired and helped countless investors succeed. Lynch's investment strategies are straightforward, so in today's video, we will see 5 simple rules for investing for beginners. Number 1. In the stock market, the most important organ is the stomach. It's not the brain. What Peter Lynch meant by this comment is very evident now, a year after the COVID-19 epidemic first emerged. People who want to generate long-term wealth but have little tolerance for market volatility should look elsewhere. Lynch advises investors to ask themselves daily whether they would sell their shares and withdraw their money if the market dropped by 20%. If the answer is yes, the investor may want to think about selling some of their shares right away. Lynch argues that investors should make rational judgments and have the conviction to stick with them, as emotional decisions may be a genuine performance killer by causing investors to sell stocks in a hurry when the market drops and buy up expensive stocks when it rises. It is best to be greedy when others are afraid and afraid when others are greedy, says Warren Buffett. Number 2. Learn the value of your possessions and the reasons you bought them. There's no shortage of hot recommendations in today's economic landscape. Whether you're interested in futures and options trading, better on a hot stock, or putting your money into cryptocurrency that claims to take you to the moon. Many people sadly believe such schemes to be true and try to implement them. Knowing what you own is more important than ever, which is why the advice given by Peter Lynch in his book, Know What You Own, rings truer than ever. Lynch thought that you should sell a firm if you needed more than 30 seconds to explain what it did. The same is true of any possible investing method. Investing in anything, whether it's stock, annuities, insurance, mutual funds, or anything else, should be done only after careful consideration and a thorough understanding of the product's features and potential downsides. You won't get rich quickly, but you can expect steady profits that will allow you to retire comfortably. Knowing why you own something is just as crucial as the first piece of advice. You may avoid making rash financial decisions by plotting a course between your prudent investments and your long-term objectives. To put it another way, you know that if you stop making investments, you will never attain your goal. You'll become a more successful investor with this level of self-discipline, which will be especially useful while facing downturns in the market. Number 3. It's possible that the stock you already hold is the best one to buy. After giving careful consideration to a stock purchase, you should stop looking for other investments. The stock markets are massive and intricate. Moving your investments around from company to firm because the other one is offering higher returns is a certain way to wind up with no actual earnings at all. Let's say you want to improve your French and decide to make a new buddy whose native language is French. Within a week, you've become fast pals. After a week, though, you learn that your friend has a next-door neighbor who speaks even better French. As a result, you abandon your pal and pay a visit to his next-door neighbor. However, upon arrival, it becomes clear that his French is too complicated to comprehend. You paid this neighbor to study French, so you can't return to your old acquaintance. If you are continually on the lookout for better stocks, you will forever be in the same frustrating scenarios. Unless there have been major shifts within the organization, you can expect your decisions to bear fruit. Having a firm grasp of the kind of companies you intend to include in your portfolio will help you determine the optimal size of that portfolio. Then, by all means, put your money into those specific shares. If you're enjoying this video, please hit the like button and subscribe to our channel if you haven't yet to show your support. Now let's continue. Number 4. Predicting the stock market is a total waste of time. As we saw in April 2020, when the world's financial markets crashed due to the COVID-19 epidemic, and every expert's prognosis and every technical analysis failed due to the unprecedented nature of the event, this phrase is highly pertinent. There are a number of internal and external factors that might affect a country's economy, and many of them are difficult to anticipate. According to Lynch, no one saw it coming to the greatest economic downturn since the Great Depression in 1982, with inflation at 14%, unemployment at 12%, and the prime rate at 20%. Therefore, the investor should not fret over matters outside of his or her control, but rather concentrate on the underlying strengths of the company in which he or she has invested. An organization's ability to adapt and survive in the face of uncertainty depends on the strength of its foundation. He claimed that his long-held belief was that any time spent studying economics was time squandered. Number 5. You cannot kiss all the girls. You don't have to kiss all the girls. I've missed my share of 10-baggers, and it hasn't kept me from beating the market. Peter Lynch. Lynch admits in his book One Up on Wall Street that he didn't go out to kiss every pretty female he saw throughout his time in high school and college. Similarly, the same rule is true of financial investments. You can't possibly put your money into every high-performing stock or mutual fund. A few supermodel stocks have slipped through my fingers, but I've also smooched a few lovely stocks along the way. I regret not buying more equities that have since multiplied, but this regret has not affected my long-term results. A common mistake made by investors is selecting funds based on how they did the previous year. They regularly rebalance their mutual fund portfolios in response to the constantly shifting landscape of the best-performing funds. Because of this, their portfolio becomes disorganized, which hinders their efforts to build money. Thus, it is preferable to stick to a strategy of discovering and investing in good, consistent funds rather than chasing every beauty or top-performing fund on a short-term basis. Beautiful, lasting outcomes are yours for the taking if you follow this straightforward technique. Well, that's all for today's video. Tell us in the comments section how this video was. I hope that you found this one interesting. If you want to see more videos like this, please consider subscribing for more. And don't forget to give comments and provide us with your valuable feedback. We'll see you in the next video with some more interesting facts and stories. And until then, stay tuned.